Welcome, a very special guest. Reza and I first met about 5 years ago, but he is my bond expert friend. Welcome to the show, sir.
Hi, good to see you, Rich.
It is. So, thank you so much. I only messaged you yesterday, and straight away you were like, "Yep, I'm there for you, Rich. I'm in."
Yeah, it's perfect timing for that conversation.
So that's it, because it's been a really scary week. We're gonna come to that a bit later, but for all the viewers, run us through, what is a bond and what's the difference between bond and equity, for example?
Yeah, I mean, there's two main types of bonds. There's government bonds and there's corporate bonds. Essentially, what a bond is, it's a company issuing a bond to raise capital, right, for finance, expansion, investment, etc. The benefit to the company is that it doesn't have to give away its equity in the company. It's a borrowing. For investors, effectively, what they're doing is lending money to that company for a rate of return over a specified period of number of years.
Okay.
Stock, obviously, as many people are familiar with, is getting ownership in a company and then benefiting from the growth in the business over time and the valuation of that. And the idea is that you want to, see that stock appreciate so that you make hopefully a ton of money. But they're both very important instruments in a company's capital structure. Government bonds, on the other side, are effectively the government doing exactly the same thing, but raising financing effectively to fund its spending.
So let's say somebody like John Lewis.
Yep.
Right. We know that they came under a bit of pressure last year.
Yep.
I've got £10,000. I think John Lewis is a wonderful company. I can literally lend them money.
You can, by buying their bonds. Exactly. That's exactly right. I would say that historically, over the last kind of 10 to 15 years, the corporate bond market has actually been mainly driven and accessible by institutions. And that's typically been, the case because the minimum trade sizes or denominations are 100,000 plus. And so typically retail investors have kind of been excluded from the wider bond market.
Got you.
There have been some retail bond issuances, but the majority is institutional. But as we come on to, WiseAlpha is obviously changing that, so we can talk about that a little bit later as well.
Brilliant.
Yeah.
And I mean, this week in particular, we've seen the bond market is bloody important, right?
Yeah.
We had the early indication Liz Truss, and everybody sort of panicking. What that was the awakening of the bond market in terms of new investors' eyes, right? Because from 2020, from COVID, everybody, the interest in investments come huge. Why is the bond market considered so important?
Right. So just a little bit of background. From about 2010 to 2020, government bond yields actually came down significantly, from around 4.5% down to, next to nothing effectively. So most people didn't really focus on government bonds, and even corporate bonds had, relatively lower yields than they do now. And, since the pandemic, there's obviously been an increase in borrowing by governments. There's been inflation. Both of these twin factors have effectively caused bond prices to fall. And
why does inflation affect bonds?
So a higher rate of inflation effectively feeds through into central banks' decisions of interest rates. So most central banks follow kind of an inflation targeting regime. So they, the typical target in the UK was 2%. So if inflation is running at 5, 6, 7%, which it was, from 2022 onwards, basically, interest rates had to rise. Now, when interest rates rise, that obviously makes the existing stock of bonds, less attractive if they've issued at low coupon rates. And so the price of the bonds has to fall in order to make those bonds attractive for investors to actually buy into. And that increased the yields.
Let's dive into that, because if the UK government in 2021 sell £1 billion worth of debt.
That's right, yeah.
And they pay a 1% coupon, let's say, keep it simple. That debt is then traded on the market until the end of its life. How does that bond trade relative to interest rates? So you've got the 1% coupon, and I get paid that 1% coupon no matter what.
Yep.
If interest rates move, how does the bond move?
Yeah. So let's just say, give the UK example. So we were kind of around 1%. inflation rates started to spike. Central bank, the Bank of England, has risen rates to what is now 4.5%. It was a little bit higher before, but what happens is that the kind of rate that investors want to lend money to the government at is at that rate or slightly higher. There's a little bit of a spread.
So like 4.5.
Yeah, exactly. So basically, you tend to see kind of, gilt yields, and yield, it is, what that means is that is the rate of return that investors require in order to lend to the government.
Okay.
So basically, they kind of move in tandem roughly with a little bit of a spread. Where things can get a little bit choppy, and this is very important for government bond investors, is, if you get caught in long-dated bonds, we call this kind of duration risk. So the longer the maturity of the bond, the higher the duration risk. What that means is that if there is a change in interest rates that's adverse to your position, it can cause wild price swings. And so that is exactly what happened to a lot of pension funds in 2022, October, when the government signaled that it was going to increase deficits, spending, and people were concerned about fiscal stability effectively and balancing the books. And so government bond yields spiked out, and the price fell quite dramatically. And those holding 30-year bonds, for example, they got hit the most because effectively, the price has to fall a lot more in order to get to that new yield, that high yield.
And in really simple terms, right, if I buy a 30-year bond that pays me 1% a year, the government 30-year yield interest rate is now 4.5%. That means every single year,
that's right,
that 3.5% has to be made up by the price today.
Exactly.
So if it's over 3 years, it doesn't really matter. But if it's over 30 years, suddenly that price is getting smashed, isn't it?
Yeah, no, exactly right. I mean, we saw 30-year bonds trading in the 30s or 40s when they'd been, trading near par. I mean, literally, that is you can see some wild, moves in prices if interest rates change dramatically. So this is what's actually happened since 2022 in most developed countries, and we're now at a kind of a level where, obviously yields around 4.5%, and they're, and everyone's, trying to work out they're going to go up, because normally what happens, as we will come on to, when people view that there's going to be an economic slowdown, typically a lot of institutional investors view the 10-year rates of some of the developed countries like the US, the 10-year treasuries, as a kind of a safe haven, a more liquid, risk-free kind of asset that they would go into. But I think, with everything that's going on today, there's a little bit of a concern are things still stable, risk-free? What is happening to the structure of the US economy? Where is debt going? Where are budget deficits going? Are they going to be reined in? There's a lot of geopolitical issues. There's the tariff policy which is going on. So a lot of uncertainty for investors. And so,
And people are starting to talk about a sovereign debt crisis in the US. So what's actually happening there, and what started to happen with bond yields and bond prices last week? Yeah,
so if I step back just to give a bit of context about what's been happening in the US, since about 2000, the national debt in the US has grown from about 5.7 trillion to what it is now today is around 36.5, 37 trillion.
Since 2000?
Since 2000, yeah. So over a 25-year period, basically, the national debt in the US has skyrocketed. And that has been predominantly as a result of, military security and war spending,
Right.
That is the primary part of it. Obviously, there's lots of inefficiency as well, as Doge are kind of uncovering. So basically, there's a lot more kind of heightened scrutiny over whether the US's capital structure or its debt load, is sustainable in the long run. And that's part of the reason why people are kind of factoring, is a 10-year really risk-free, or do we need a little bit more juice in the yield in order to take the plunge and buy more of it?
What do you mean by more juice? More juice?
Well, higher yield for the higher risk. So basically, the US is perceived as more risky than it has been in the past, simply because of the higher debt load. And then obviously Trump's tariff policy recently has caused a bit of uncertainty in the markets. It was simultaneous, which the markets weren't expecting. So across all countries,
Yeah.
the formula was used was actually quite aggressive. So that took the market by surprise. And so that's part of the reason why, yields moved out or moved higher, particularly the 10-year and the 30-year in the US.
Because when you've got so much debt to refinance,
Yep.
it's like any market, isn't it?
Yep.
You've got to make it more attractive to attract the right number of buyers.
That's exactly right. So, I mean, there comes a point where, economists and, people at the central banks can kind of feel, what the liquidity is for their auctions, what the demand is. And, right now where the US is that people can kind of see, they basically see 1 to 2 trillion per quarter of budget deficits, basically, since the Biden administration came in. The pandemic, obviously, and the spending related to that, but also, some of the other policies which were implemented, the war funding, etc. It's all kind of, shown that, effectively the spending is unsustainable. So this is part of the reason why Elon Musk has made very clear that something needs to be done in order to rein in spending, balance the books, give regaining investors' confidence, in the debt, and so that, borrowing costs can come down, because obviously, clearly, what you don't want to do is have to finance your country and your spending at very high rates of interest and never be able to credibly pay that money back. So that's the adjustment is basically what's going on right now.
Is there a so basically, if you run a 1 trillion budget deficit per quarter,
Yep.
is there does that just get added to the total pot, the total debt?
Yeah. So, well, I mean, the interesting thing is that yes, it does, right? So basically, like if you have a gap between what you're spending and what you're getting in terms of tax revenue, right? That's a loss effectively that every year that's added to your and you're funding that through the issuance of debt, right, and money printing, which is at the same time. So basically, your national debt is increasing exactly by that budget deficit every quarter, and if that gets to a point where investors start to think, hang on, this is not sustainable, and there's actually a risk that I might not get paid back on, what I thought was a risk-free asset. And suddenly they're thinking, okay, well, I don't, 4% isn't that attractive anymore. I need 4.5%. But it can also get into a runaway perspective where, it can get, a lot higher. And then when you pay interest that actually, is so much that actually adds to the deficit, then it makes things even worse. So basically, the US is going through a structural adjustment. It's trying to, get its debt down to sensible levels. It's trying to find ways in order to reduce the debt. One of the ways is obviously reducing inefficiency in government spending, which is what Elon Musk and Doge are looking at. And the other way is tariff policy, because historically, the US, up until 1913, which is an interesting year actually, always made loads of revenue from tariffs, because its market was vibrant. People wanted to access it. People paid to access it.
Right. And Trump's read that history book.
And he's also seen that governments around the world, including Europe and China and other countries, they utilize tariff policy quite regularly. It's not a bad thing for those countries. It's only a bad thing when the US does it.
Yeah.
And so basically, he's kind of cottoned onto that trick that actually, if I want to rebalance, create a fairer, what he thinks is a fairer trading system, i.e. kind of balancing the kind of trade deficits between countries like the US and China, he's figured that tariff policy is an interesting way to do it. And he wouldn't be wrong. Obviously, transitioning to that type of policy, will cause a lot of Wall Street executives to be in a bit of a panic, because the effect of tariffs, isn't just on the countries where you're implementing the tariff on their goods. It's also for US corporates. So if I give you an example, Nike, for example, buys a lot of its shoes from China. Let's say it costs $10 a shoe, right? They then sell it up, mark it up, sell it $100. If there is a 100% tariff on that shoe that costs them $10, that's been made in China, they have to make a decision because they're paying that $10 to the US government when they import. They have to decide, are we going to push up prices, to compensate for that extra cost risk, or we're going to take the hit. And in reality, what's going to happen in a slowing market is that it is actually probably, in my view, it's going to be the corporates which take the hit. So what you're going to see is all the sectors which rely on China for cheap, components. The corporates will have to make a decision as to how much their profit they're going to have to sacrifice. And so what you'll see is the valuations of those come down. I know that's not actually happening right now. So the recent move by Trump to exempt the electronic semiconductors, computers, smartphones, those are important strategic sectors for the US economy because, robotics and AI are obviously the future. That's where the competition between China and the US is going to be. So he's exempted those because, in his view, investors were getting yippee, about that. So obviously, like Apple's rebounded quite strongly, up 6%, Nvidia up 3 or 4%. But what's strange is that companies like Nike are also up a little bit as well, but they're the ones who are not going to benefit from that change in Trump, that policy. Yeah. So I actually think, to cut it short, I think it's basically what Trump is doing is effectively engendering a redistribution of wealth from the top 10% in the US whose wealth is tied up in stocks. To the working middle class by onshoring manufacturing,
Main Street,
increasing tariff revenue, because that tariff revenue that goes into the government, that goes directly into the treasury. That's the people's purse. So basically what he's doing is a redistribution of wealth. I don't think the market has realized that. Most analysts on Wall Street will tell you, oh, it's going to be immediately massively inflationary. It's bad for everything. The people who are saying this are the CEO of Nike, the
ones that get hit,
the Wall Street guys, the BlackRock, who are really, in reality, this is going to be, in my view, an adjustment on, the stock market is going to be less of a focus. Quite a lot of US corporates are going to, are going to have revisions down. It's the stock market which is going to take the brunt of the change. It will also be China and other countries who have the tariff rates.
Yeah, but last week it was the bond market that started to take the hit. Now, explain why we started to see the focus on Wednesday shift from equities to bond treasuries coming off.
Yeah, so look, obviously stocks went down, but normally when stocks go down, if there's concern about economic worries, people buy 10-year treasuries and then the yields come in, but actually the
prices go up.
Yeah, the prices go up. Yeah. The reverse happened, right? And that is a symptom of uncertainty. Investors just didn't know what Trump's tariff policy was going to do because they were caught by surprise. Yeah. So that's why there was an issue move. I mean, they've come in slightly since the kind of tariff revisions and things like that.
Yeah.
But in general, look, you've got, as I said, that backdrop of high debt. Heightened investor scrutiny, which is, feeding into people's views on whether treasuries are really a safe, risk-free asset, right? Yeah. And you've got uncertainty. And so it's that uncertainty which caused those yields to rise. Now, we just need to see what happens over the next few weeks in terms of negotiations around tariffs. We need to see, I guess over the short to medium term, over the next 12 months, how successful Doge is in terms of cutting spending, how that feeds through into economic growth. We also need to see what's happening to inflation expectations because those are rising right now. So
we've got that measure coming in this afternoon, actually, at 3 o'clock.
Yeah, that would be interesting. But there was also a survey done by the University of Michigan where people's expectations are now at 6.7%. For the rest of the year, which is actually a lot higher than it's been. So that affects consumer purchasing decisions. It affects, companies' purchasing decisions. And so people kind of need to see a little bit of, a little bit more data, to kind of, set their expectations on what's going to happen in terms of the economy, what happens in terms of inflation. And that will feed through into bond yields. In the meantime, they're going to swing up and down, until that uncertainty.
We've got a great question from Neil there. Who do you think was selling treasuries last week?
Yeah, exactly. Well, I'll tell you that since 2017, when China had 1.2 trillion of treasuries, at the end of 2024, they held, I think it was around 750 billion. It's kind of estimated that they've sold probably another 50 billion. I mean, it's not for certain. You need to see some of the disclosures come out, but I get a sense that some of that selling is China, and that's just been the case for the last 6 years. They've been reducing their holdings of treasuries, and they may have accelerated it. I don't know what your view is, Rich, but that could have also been part of it.
Yeah, it's really tricky because the Japanese, as they were walking into the White House, just give it a little nudge. Because how much would it take to see pressure on the Treasury price?
Actually, not a lot these days. So it depends what liquidity there is in the market. Typically, in normal times, and especially if the Fed is supporting and creating liquidity in the market or buying its own debt, typically, selling 10 billion in a market, it can be soaked up, right? But when you've got this kind of uncertainty right now, and people are selling, even selling 1 billion or 2 billion, it can actually create some meaningful moves in the yield, you know. And so we're kind of in a slightly different market where, just even smaller, relatively smaller, sales of treasuries can actually increase the yield.
So you mentioned at the start you got sovereign bonds and you got corporate bonds. Obviously, there's a difference in the issuer, but how is the market different? How does the corporate bond market trade?
Yeah, so the corporate bond market is got a lot of diversity in it, right? So with government bonds, you're kind of focused on interest rates, and you're focused on duration risk. That's pretty much macro.
And which government it is.
Yeah, and which government it is. And for corporate bonds, you also have to take into account credit risk of the company. So corporate bonds tend to offer higher coupons, higher returns to attract investors into lending to them effectively and buying their bonds. And obviously a company can go bust, which is a lot harder, for governments to go bust because they can obviously print money, they can increase taxation, so they have much more flexibility. People have a lot more faith in governments generally. We'll see whether that remains the case. But generally there's a lot more risk in corporate bonds, so you need a higher rate of return to do that. Now, this period of time, what's actually happened is, similar to government bonds, investment grade bonds, which is the lowest risk type of corporate bonds. So they're the high credit, highly rated, from a credit rating perspective, bonds.
Is it AA?
So it's from treble B upwards.
Okay. I noticed that your first name has AA in it. Is that,
exactly.
Is that a coincidence? Or
well,
did you add
it should have 3, so it's AAA. But basically, you mean the IG bonds tend to have long durations, just like government bonds. So actually, they you saw exactly, for example, there's a lot of bonds issued by big conglomerates like BAT, for example. They got a 2052 bond, 2.25%, but it's 2052, so it's 30 years out, right? That bond is trading at 43, right? And it had been trading at the 70s, 80s level, back in 2022. So, they can also get similarly hit. So investment grade corporate bonds tend to behave more closer towards, how government bonds behave, when interest rates changes in the economy. The high yield bond market, which is actually the most interesting part, which is where you can generate returns in the UK, at least currently, of between 8 and 12%.
To 12%.
Up to 12%, yeah. So a lot of bonds, high yield bonds, which tend to be kind of shorter to medium duration. So there's a lot issued at 5-year, some at 7 and then 10-year. But generally a lot shorter maturity or duration than investment grade or government bonds are issued at. The focus is on the credit risk because obviously they're borrowing more. So people are looking at their cash flow. Can they repay the debt back at the end? Can they pay their interest? So a lot more, investor scrutiny on it, and obviously that's why there's higher returns. But these ones right now, high yield bonds, what you saw is...
Give us an example. What if I wanted to look at like a sort of So 8, 9, 10% return. What kind of companies am I lending to?
Well, one of the most popular bonds on WiseAlpha's platform. So we have a fractional bond platform where retail investors can buy from £100 into all the corporate bonds, sterling corporate bonds.
Right.
We're the only platform that do it. But one of our most popular bonds on our market is the Ocado 10.5% bonds that were issued last year.
Ocado.
Yeah.
Right.
So everyone knows Ocado.
Lend money to Ocado.
A lot of people here in London have used Ocado, bought, shopping from them. It's got a multi-billion market cap, so it's traded on the stock market. To give you an example, over the last year, that stock has dropped 21.3%, over 12 months. There's no dividends paid out by Ocado, but the bond has pretty much traded up or higher than par. So basically around par.
So that's a great example of the difference between a stock and equity then.
Right.
Between equity and...
Well, this is the classic example. So you've got the stock, which has lost 21%, but the bonds have made you 10.5%. So,
because
which is the better trade, right?
Yeah.
And if you actually, in the UK, it's interesting. If you actually go back through history, so over the last 25 years, if you actually look at the returns, the FTSE All Share today, from 1999 to since the FTSE kind of indexes were created, the FTSE All Share has generated 5.7% a year per annum. According to Barclays, on the investment grade side, it's 4.5% over the last 25 years.
Right.
Same period of time. High yield has generated 9% per annum. So it really is the secret asset class which generates consistent compounded returns over time.
Yeah.
Has generated the most wealth for UK investors. If you're just looking at UK financial assets,
right.
Obviously the S&P 500 in the US on the equity side has done fantastic well. So you want to be invested.
Yeah.
You will want to be invested in that.
And that's why people talk about this 60-40. 60-40 equities to bonds doesn't necessarily mean you've got 40% in US treasuries, does it?
Yeah, no, it can be in other forms of debt, investment grade corporate debt, and potentially some high yield as well.
We're getting some questions in for you. So, can the American 10-year bond be downgraded, and what would happen there?
Well, look, I mean, I don't think any of the ratings agencies would have any political maneuverability in order to, downgrade from a credit rating perspective at this point. There's, the US government is basically, going through a transition period where it's structurally changing the economy of the US. It's trying to get its debt and spending under control. And so it's going to be afforded a bit of time before you end up having those decisions. Okay,
so you wouldn't expect anything in the near term?
Yeah, no, not unless they really hate Trump.
Besant calls himself the world's best bond salesman. Would you agree with that?
Well, I mean, he has had a long history working at hedge funds. I can't give you a view on that, but he seems to have a fairly screwed on head. I think he knows what's going on.
Excellent. Right, Reza, you're not on social media yet. I think we need to get you on social media. Some of these questions would be incredible to have in that sort of platform at the moment. So
absolutely, it's something I'm working on. So we're gonna be doing a bit more influencing. So
brilliant.
I'm on Twitter. Handle is at EuroYield. Also going to be hopefully launching TikTok and doing a bit more Instagram. Obviously, you can follow my company WiseAlpha, which has a marketplace of 150 bonds. So if you just want to understand what's happening in prices in high yield, gilts, and government bonds, you can take a look there.
Great. WiseAlpha and EuroYield on Twitter.
At EuroYield, exactly.
At EuroYield. Excellent. Hopefully you'll come back at some point.
Looking forward to it, Rich. Thanks for hosting.
Awesome. Thank you very much. Cheers. We'll see you. I'll see you tomorrow, but we've got Axel Rudolph coming in. What's the trade of the week going to be? Last week, he didn't want to enter the market. Is he feeling a little bit more confident about things, or is there going to be something that jumps out somewhere else in the market? Wait and see after the break. I'm going to be sitting there with the button already. Otherwise, good luck in the US trade this afternoon. Let's see where Apple closes. Not too much volatility is what I am hoping for. A nice, relaxing week into Easter holiday. How about that? Unlikely the way things have been recently. We'll see you after the break.